All right, folks, and welcome to our Zoom stock analysis, where we're going to apply our three-step process in evaluating so that we can come up with our own conclusion in whether should we buy the stock or sell the stock. In terms of our processes, number one, the situation overview by performing due diligence. Number two is applying our technical skills to determine how fast they're growing revenue, what is their earnings power, margin expansion or contraction, so that in our third step, we can come up with our investment thesis and also apply a price target on the stock to just, again, help us determine should we buy or sell the stock. Because year to date, Zoom has outperformed the general market and has also become a application that is ingrained in the normal day-to-day activity of business operations, where people are now working from home and employers are looking for ways of utilizing technology to allow them to still be productive and run their business as nothing has happened. So again, I hope you find value in this, and if you're new and this is the first time you're watching one of our videos, please hit the subscribe button on our YouTube channel, turn on the notifications so that you'll be the first to get our notification when we release or upload our videos in our YouTube channel. So with that being said, folks, let's get right to it. Just a little overview on our three-step process so that you can better understand what it really takes into simplifying something that can be very, again, intimidating and complex. It's all about simplicity. Number one, your situation overview has to deal with performing due diligence. What does that mean? You access all public information that we have available from Zoom, like the company website, their press releases, the SEC filings, reading their earnings report so that you can get a better understanding of how they perform in the latest quarter and just get additional information on how the company is performing from an operational standpoint, and also get a snapshot or their profile picture on the balance sheet, how much cash they have, how profitable the business is, which again gives us an indication of the fundamentals. The second part of our three-step process is applying our own technical skills. You always hear in finance a lot of terminologies and jargons that might seem intimidating because there's just a lot of terminologies out there to learn. But with the second part, in applying technical analysis, is quite simple. Learn methodologies that we apply to value businesses. That could mean DCF analysis, comparable company analysis, sum of the parts valuation. Also, if you understand accounting, you can read the financial statements of the company and just apply your own judgment on whether or not the company is generating free cash flow, which they can later use to grow and expand. So that's more of the second part of understanding how to apply technical skills. And lastly, part number three, how do you come up with a price target or formulate your own investment thesis, is by applying the analysis from your valuation methodology, which we're going to apply today on Zoom. So that's just a little bit overview on our process to just introduce you to what professional Wall Street really do when they're analyzing a business. And of course, we could go very deep in each and every one of these steps or process that you're seeing here on the slide. So in terms of the situation overview with Zoom, I always first like to look at the stock. How has the company stock performed year to date when you compare it to the general average, the S&P 500, the NASDAQ, and the Qs? So it's very clear in this slide, Zoom is up 154% year to date. I mean, think about it. While the NASDAQ is up 3.5%, the S&P 500 is down 11%, and the Dow Jones Industrial Average is down 17%. You have one outlier in the entire market, Zoom, up 154%. That means that during this year alone, in terms of market cap, they've increased their value by $29.6 billion, as I'm showcasing right here on my slide. Okay, now here's what's interesting. During the whole market correction, which really started in February and lasted through March because of the coronavirus pandemic, look what happened with Zoom stock. The stock increased 40%. And if you've been following the stock analysis over the last several weeks on Amazon and Netflix, you've also noticed that those companies also outperformed the market. But during the period of the correction, those stocks also were severely impacted. Meanwhile, when you see Zoom, they weren't impacted at all. They actually benefited. And the reason for them benefiting is what's happening with business, employees, and consumers. The change in behavior, the new conditioning is that people are working from home, and employers are learning that their employees are becoming more productive from home. Why is that? If you really think about it, number one, you don't have to wake up early in the morning, get ready to spend an hour or two commuting to get to your job, which means you're wasting time during that whole period that you could probably be using to be more productive from home, working on your assignment or any projects that you have. The other point is video conferencing has allowed people just to communicate as easily as if they were doing it in an office setting. So Zoom has perhaps the best video platform to allow employers to engage in their activity, which again is elevating their productivity. This last week, the CEO of Twitter, Jack Dorsey, made an announcement that said employees from Twitter can work from home forever. So he's the first one now of large tech companies that is signaling that people can now work from home. Now, what do you think it's going to happen because of that? Well, other major companies are going to also start to do the same. Again, this will leave a legacy, and the new condition is that working from home is going to be normal. And the benefit from the employer standpoint, because you always have to look at it from different perspective. From the employer standpoint, what do they get? They get to save on their costs in office space. So commercial real estate, that market is definitely going to be under a lot of pressure because they're going to have a lot of vacancies. I mean, there's articles on how the New York commercial real estate market is in a shaky foundation right now because employers may not renew their leases because people are just going to be working from home. Now, from an employee standpoint, from your standpoint as the audience, you're going to notice that working from home might actually be something that you enjoy. Instead of commuting, instead of working next to someone that you perhaps may not have the best relationship with, you'd rather work at home, spend time with your family, with your kids, and really just be more productive. That is really helping. And that's what I'm also hearing from my friends, from my personal relationships that work in finance. They work on Wall Street. They don't have to be in New York. Some of them are actually working in other parts of the country, and they enjoy that. They feel rejuvenated. They have a better sense of an increase in morale because they're not locked into an office setting. So this is just giving you more indication of what's happening, and Zoom is definitely benefiting from it. I mean, just look at it at the beginning of the year. The stock price was around $70 right here. This is about $70, and right now they're trading at around $165, give or take, in a very short period of time. In the first 1 or 2 quarters, this stock is up 154% because of the change in emerging trend and consumer behavior, and you're seeing it with Zoom. So Zoom is turning out to be one of the winning stocks of the stay-at-home economy. All right, so I hope this slide really helps you understand from a chart perspective what's been happening in the capital that has been flowing into this stock because of their business model, video conferencing application, and the software that they have. What does that translate from a value, from a dollar value standpoint? Here it is. Increase of 29.6 billion. Went from 19 billion in equity value or market capitalization to 48.7 billion. I mean, it's just unbelievable. Now, to drive this point even more, let's look at the next slide. When you compare Zoom stock to other industries that have negatively been impacted by the coronavirus, in this case, the airline, it's such a clear divergence. It's an inverse correlation. It kind of feels like people are selling the airline stocks and buying Zoom stock. Okay? It's just the new adaptation of what's been happening with the economy. So for those of you that want to learn a little bit more about fundamental investing, growth investing, and having your pulse on the market real time and not looking in hindsight what has happened over the last 6 months, pay close attention to the stocks that are outperforming on a daily basis and on a weekly basis. Because if you can identify those stocks that are outperforming on a daily and weekly basis, then you can apply this simple 3-step process by understanding the situation, the fundamentals of the business, looking at the future earnings expectations, and coming up with your price target, which should give you enough reason and enough analysis, right, to perhaps buy the stock where you have a 3, 6, or 12 months time horizon outlook on your investment thesis. And we're gonna see a little bit more of that in the upcoming slides. And also when I show the actual technical chart of Zoom, where would have been the ideal time to have bought this stock, which represents what I just said. Focus on stocks that are outperforming on a daily or weekly basis. I'm gonna pull up the chart later and show you what does that look like so that you can see it from a practical standpoint and it becomes visual, okay? So this is just quite interesting, you know, when you compare Zoom with the airline stock. And I've seen other people out there and other analysts, you know, saying that you should buy airline stocks because they're gonna be around and, you know, in 10 years you might make 3, 4, 5 times your money. But what I do ask is, okay, what is your research? What is your analysis? Have you looked at how much debt these airlines really have on their balance sheet? Have you looked at the amount of cash flow that they're generating? Have you looked at their capacity? Do you really understand the economics, the margins, the profitability of each and every one of these companies? What about the maturity that they have on their outstanding senior debt? Okay? If you're an equity holder, you might actually be wiped out. So you need to do your own analysis to determine if these companies are on the verge of bankruptcy. And if they do file for bankruptcy, if you're an equity holder, you're gonna get wiped out. What happens is through the Chapter 11 bankruptcy process, the debt holders, they renegotiate with the management team and the existing, you know, equity holder, whoever's still in there, they renegotiate. So the debt holders, they get a haircut, and in some cases they become the new equity holder, and then the company does a new IPO. So the new equity holders were the existing debt holders, and then they might replace management, they may come up with a new strategy, a business plan to make the company grow so that the debt holders that are now the new equity holders can participate on the upside and recuperate the amount of money that they lost from the haircut that they took during the whole restructuring process. That's Chapter 11. And there have been several outspoken investors talking about exactly that. Shamad Hapatia is one of those outspoken investors that was on CNBC, and he was exactly saying that. He said that, look, there is a lot of misinformation by the investment community, specifically coming out of Wall Street, that big firms, big organizations, big companies should not be let to fail. And he's saying, no, they should be let to fail because they're going to go through the bankruptcy process, which is Chapter 11. If this is new to you, do your own homework, do your own research, understand Chapter 11, because it's actually interesting, and it's a whole nother side of finance that most people don't understand. But if you're someone that want a career in investment banking, then something in a restructuring team could be quite interesting. It's exciting to really learn, why did this company fail? What was the economics of that industry? What was the change in consumer behavior? What was the new technology that disrupted that industry, that forced the stock to decline by 99% and then pushed the company into bankruptcy, and now re-emerging, what is the new plan? When you get to see that whole process, it's really a learning experience. So that's a whole nother side of corporate finance and investment banking that I thought I should share to give you more information on the broader spectrum of the world of business and finance. So this is quite interesting slide. So let's just continue and move forward with our situation overview and understand, why did the stock increase so much? So this takes us to earnings, their full year financial results. And you can see on this particular slide that is so clear that when they reported their fiscal year 2020, which ended January 30th, after they announced Q4, look at the top line revenue numbers. They beat significantly. They were over by $12 million. I mean, the street was expecting $610 million, and they reported $622 million. So it was above expectation, better than expected. When you hear better than expected, is probably because there is a lot of demand for that particular product or service. It could be digital or it could be a physical product. It's your job as an analyst to look at the press release, look at the reports, try to understand what that product is, and see how does it fit in the current environment in the economy. And obviously it is so clear right now. I mean, just look at the conversation that we're having right here. We're conducting this through Zoom. It's a beautiful thing. I'm doing this from my office in Puerto Rico. I'm usually in New York, but because of this pandemic, I'm in my office in Puerto Rico, and technology has just enabled us to do this on a Saturday afternoon. Some of you are actually watching this from bed. It's just a beautiful thing that we can all still learn, be productive, and get valuable information across in this format. And Zoom is providing that. So this was from a financial standpoint on the top line. Look at the bottom line. This right here, EPS fully reported, this is GAAP. They had 3 cents was what the street was expecting, and they beat by 6 cents. So the fully reported number was 9 cents for the year. So they definitely beat on the bottom line. And here's what the CFO of Zoom said. We added approximately 7,800 customers with more than 10 employees quarter over quarter and exited Q4 with 81,900 customers. For the whole year, they increased their customer base by 31,100. That is 61% year over year. Now, to put things into perspective, when you're looking for companies that are also known as momentum stocks, growth stocks, this is what you want to pay attention to. You want to see better than expected, year over year earnings growth of over 50%, top line acquisition, customer growth of over 50%. This is what that's illustrated. If you remember in the previous stock analysis case that we did on Netflix, it was very similar to that. Increase in their users, in their paid subscribers. Same thing with Amazon, more people conducting business online. These are the companies and the stocks and the tech sector that have been driving the entire NASDAQ upward. And the ones that is definitely outperforming all of them, here it is. It's Zoom. So you're starting to see now the stock price in relation with the financial performance. So at the end of the day, it's the fundamentals, is the earnings growth that drives the stock price. And in this case, up 154% year to date. So pay close attention to earnings and try to read between the line and dissect the numbers that management is showcasing in their earnings report. Here's also something interesting that I picked up from their remarks, their press release that they prepare for investor and the public community. In quotes right here, with the reliability of high quality video platform, we have seen a large increase in the number of free users. Meeting minutes and new video use cases. So again, you're seeing that their application, their product is in high demand. Now the question becomes, is this going to continue after the whole coronavirus situation is in the rearview mirror? After all of the stay-at-home orders have been lifted from all states and then resume a sense of normality? Will Zoom continue to grow at the rate that it did in Q4? Okay, so that's the question right now, and that's open for debate, and we're going to see what other analysts on Wall Street are actually saying on that specific point that I just made. So let's continue to the next slide. So now you're really reading between the line and going deeper into the numbers so that you can see what management actually said about their performance. So a couple of things that I want to point out here and highlight. From a revenue standpoint, revenue for the full year was $622 million, which increased 88%. So from 2019 to 2020, revenue increased 88%. That is that's, for lack of a better word, is insane for a company of their size. And again, it shouldn't come from a surprise. I mean, compare that to Amazon growing revenue at 15 or 20%, or even Netflix growing revenue at 20%, right? Zoom is growing faster than those companies. Therefore, it might probably demand or require a higher multiple than other tech stocks, because they have the growth. And growth, to investors on Wall Street and analysts, it's like crack. They're addicted to it. Why? Because not every company is generating revenue at this rate. You have about 7,000 publicly traded companies. How many of those 7,000 publicly traded companies are growing revenue that fast? Not all of them. About 1%. It's your job to find that 1% and then understand the fundamentals. So that's one of the things that I want to point out. I also wanted to point out their international expansion. And this is quite interesting. So from a revenue standpoint, right here, when you're looking at international expansion outpaced the high rate growth in American revenue in Q4, our combined APAC and EMEA revenue grew by 84% and represented only 20% of revenue. Okay, so this is more on the international side. So if international revenue only represents 20% and North America, the US, represents 80% of revenue, that means that the international market might actually be bigger than the US. I mean, the US, when you look at total population size, is 350 million Americans, give or take. But when you look at the rest of the world population, it's about 7.5 billion. So there is a larger international market out there that can become bigger than 20%. So there is still room for growth, I feel, when you look at it from that perspective, okay? In addition to that, when you look at their cash flow, this is important. Net cash provided by operating activity was 151.9 million for the fiscal year compared to 51.3 million. Now, on a free cash flow basis, free cash flow was 114 million. This is an important number. I like to see this because it means that from their core operations, from the day-to-day activities, their cash flow positive. When you subtract from that operating activity cash, when you subtract your CapEx, then you end up with free cash flow. That free cash flow you can use to reinvest in your business, to open space, hire engineers, develop your product, issue new alternative competing products so that you can cross-sell amongst your existing users and open offices in other parts of the world and continue to expand. So they don't have a liquidity problem because they're free cash flow positive. And it also means that if they want to raise capital, they don't have a problem with that. Whether it is raising capital via debt or equity, they can do that if they need to, and they can probably borrow at a cheaper rate than another competing company that is not free cash flow positive. So that's the importance of being free cash flow positive from that perspective. In terms of major additions during the quarter, from a corporate standpoint, Johnson & Johnson. During the call, they acknowledged that Johnson & Johnson picked them as their video conference application or technology that is going to be spread throughout the entire Johnson & Johnson business operation, right? And Johnson & Johnson, they have over 100,000 employees globally. So they're just giving them a little shout out in their conference call. I like when they did that. So it's just acknowledging, hey, Johnson & Johnson, thank you for choosing us. Here's a little shout out, kind of like boosting their ego to get maybe free press as well. But it's just quite interesting, right? So they have Johnson & Johnson. Who else is going to come? They also talked about, I believe it was VMware, which is another tech company, but also educational institutions are using Zoom to conduct their classes. And there's been articles out there where at the university level, people paying, $50,000 for annual tuition to get video in this particular format at a university level. Now they're starting to question, is it even worth it, right? Is it even worth it to pursue a 4-year degree in a new economy where people are going to be working from home and everything is becoming a lot more digital. So that's up for debate as well. It's your job to do your own homework, your own analysis, search within yourself and see if it's worth it. But more importantly, have a longer term time horizon, 5 years, 10 years. Where do you want to be? And what skills can you learn today, whether it is in a classroom setting or whether it is outside of a classroom setting, that you can learn to get you a little bit closer to that longer term vision that you have. And I think, this pandemic is really changing things and is leaving a lasting feeling within consumers, students, professionals, employers, that it's just going to change how we conduct operations. It might be for the better, or it could be for the worse. It really depends on where you're at in your situation. Now, going forward, the guidance that the company gave, it's right here. So they're expecting revenue for 2021 to be 905 to 915 million. That's 45 to 47% growth year over year. Operating income, they're expecting it to be between 110 and 120 million, and EPS between 42 and 45 cents. That's for the for 2021, based on about 301 million shares outstanding. So here's what you need to do now. They have their upcoming earnings later in June. That is going to be a major catalyst. If they miss expectations, you better believe this stock will probably be down 10, 15, maybe 20%. But if they beat expectations and they're managed to convert their free users into paid users, then they're firing out all cylinders and they have a really good product. And that means that revenue will probably be higher than what they're projecting. So they're looking at it from internally. This is management. They're saying, look, instead of us overestimating and under-delivering, why don't we underestimate and over-deliver, right? That's the game that a lot of these high-growth tech companies like to play with Wall Street analysts. They set the bar here, but in the back of their mind, they know they're going to come up here. So when they set it here and they beat expectations and their numbers are up here, the entire investment community says, oh my God, they're doing so great. They beat even my own expectations. Let's buy the stock because it deserves a higher premium. And you get all that frenzy, right? So again, you have to look at it from the management standpoint. Put yourself in their position and look at the business like the operator. So before you do this analysis, put your position as the CEO. How will you grow the business? How can you monetize the free users and cross-sell multiple products? If you figure that out, then when you're doing your analysis, the numbers come to life. And you can probably do more sophisticated analysis from your own creative thinking that connects cross-selling, user engagement, user acquisitions, and maybe give you a better revenue buildup in the sense that your revenue projection will be more accurate. That's how I would think about it if I really had to do a revenue buildup on this particular company. Maybe you're more creative than me. Maybe you have better analysis ability because you have access to more information and you can project revenue growth even more accurately than other analysts. But it's about the process and being able also to defend your numbers. So we're going to be paying close attention to the upcoming first quarter numbers to see if this momentum can continue to carry forward. So that's from a fiscal 2020 year results highlight. And this information, again, you can find it on their company website by reading the press release under Investors Relation. So every time a company report earnings, you should be doing this homework. Exactly what I just did right here, that's your job to do it on any company that you may own in your portfolio. All right, so let's continue. So in terms of their response to the coronavirus, every company that we've been covering up to this point in a stock analysis webinar lecture like this, they've all have made significant changes to their operations in order to adapt to the new challenging business environment in real time. Companies that are failing to do that, they're going to go under. And you already begin to see that. I mean, on the retail side, retail sales that were reported on Friday, actually yesterday, came worse than expected. the number was 16.4%. Retail sales declined in the month of April. That means that foot traffic at all of these retail stores that are located in malls are not seeing people coming in. So revenues are declining. Meanwhile, they have overhead expenses, so they're burning through a lot of cash and they're not being profitable. That has led to many companies filing for bankruptcy. One, J.Crew. Another one that is contemplating bankruptcy is JCPenney. Other companies that have announced bankruptcy in the fitness centers, they have about 400 fitness facilities across the country. They also file for bankruptcy. So this is affecting every sector, especially the retail sector. And when you see Zoom in the digital space, here's how they are basically responding. Number one, given the recent emergence and growing numbers of corona cases in the US, Zoom directed headquarters employees to work from home, unless there is a reason for them to come in. But most of their employees, they're all working from home, okay? And again, like Twitter said, Jack Dorsey, all of their employees can now work from home forever. And not just them. In the finance world, JP Morgan, Goldman Sachs, Credit Suisse, Morgan Stanley, they're also thinking the same because they're seeing that the level of productivity is increasing. So from an employer standpoint, think about this scenario. Let's say that you own a business and you are spending about $100,000 a month in commercial real estate space or in office expense. That equates to about $1.4 million a year in rent. When you have 90% of your staff working from home and you're still paying for that empty office space, $100,000 a month, do you need them to come back when they're as productive and they're telling you, hey, I love working from home. Can I stay at home? I'm more productive. I want to spend more time with my kids, with my family. I love walking my dog. It just gives me a little bit more energy and I feel so much better. Are you going to take them away from that comfort, put them back in the office where they don't want to be in? Probably not, right? So you're also going to save money from the rent space in those offices. So chances are that you're not going to continue to renew that lease and keep paying $100,000. So take that little example, take that little case and apply now to hundreds of thousands of businesses across the country. And if you do your own Google search and type commercial real estate sector, you're going to start to see dozens of articles talking exactly on that point that I just mentioned. And that could be a big turmoil for commercial real estate. And the debt holders that finance all of these commercial real estate properties, what do you think it's going to happen to their debt when their real estate, when the commercial real estate owners, right, the owners of the property, when they cannot collect that rental income to service the debt? What do you think is going to happen to those debt holders? They're probably good. I mean, right now they're already shaking. Oh my God, I gave $1 billion in loan for them to finance this huge giant building of commercial space, and now they're not going to be able to pay me. What am I going to do? And you know who owns a lot of that debt? Banks and pension funds and hedge funds and other private equity investors that only focus on debt investing. And that really gives you more perspective on how the coronavirus impact is having, not just on retail, not just on the airlines, not just on casinos and restaurants, but it's going to spill over to the real estate sector and to the financial system, the financial sector, banks that end up owning these debt because they're financing, right? They're lending big property developers the money to do that. So if you want to look more into that and come up with an investment thesis over the next 6 to 12 months, that's one way of looking at it. So that's on Zoom when one of their response, mandating all of their employees, you can work from home. Also, point number 2, Zoom is doing everything they can, especially for global educational institutions, to provide resources and support our customers and those navigating the coronavirus outbreak. Okay, This is very important right here. Why? Because this will leave a lasting legacy effect where students now at the university level, there's 20 million students in the US, right, from the college population level, 20 million. Most of them are now finishing their semesters through this format, through this video conference. It is amazing that from a marketing standpoint, Zoom doesn't have to spend ad dollars, advertising dollars to get their brand across 20 million people, because universities are conducting their classes through this application that has Zoom on it, and everyone else now in the entire economy and maybe in the world knows Zoom. I mean, it's amazing, right? How adapting your application, you can basically elevate your own brand when other people are seeing it. So major institutions that are delivering their educational service to thousands of students, I mean, that just raises eyeballs. I mean, it's a great strategy when you give the product away for free, and if you like it, hey, go ahead and upgrade to the paid subscription. And look at us. I mean, there's about 100 participants today in this call. Many of you, if I don't know if you've not been aware of what Zoom is, well, now you know. Okay, and apply this case over and over and over, and this is why everyone now knows Zoom. Okay, so other things here is we are proactively monitoring capacity globally to maximize reliability and usage. Okay, so they're improving more of their product. In China, we have removed the 40-minute limit of free meeting, and we are providing informational sessions on demand. Okay, so before there was a limitations to how much time you can use the Zoom video application for free. Now they removed that limitation. Now you can use it more to talk to your friends, your families, and basically have video conference, get together or parties. I mean, you guys can look into that and see what's happening. There's DJs now that from their room, they're broadcasting their soundtracks. I mean, it's amazing how people are adapting to this, and they're conducting their normal business or their level of productivity, whatever product or service, whatever it is that they create, they're sharing it with the world through this application. And it's just amazing. It's a beautiful thing. Now, here's something also that's important that has happened during the pandemic, and as Zoom increases their profile, it also going to attract some threats. One of those threats was lack of features in their security and privacy process. And on April 22nd, they hit a milestone on a 90-day period of improving their security, their privacy agreement and process, so that people cannot jump into conferences uninvited. And that was actually what was happening. People were actually hacking into other conferences and taking screenshots and photos. I mean, you've seen it on Twitter. People that have taken their laptop while being in a conference go to the bathroom. It's unbelievable. It's one of the unintended consequences of adapting video conferencing. But that was a gap. That was one of the things that they've missed in their application, but they're patching it up, they're fixing it, they're doing things about it. This is very important. They also made an important acquisition because it gives you more what they're doing from an operating standpoint to continue to expand. This is very key. So on May 7th, Zoom acquired Keybase, a secure messaging and file sharing service program, and announced goals of developing the most broadly used enterprise end-to-end encryption offering. What does that mean? Let's think about this carefully, right? The reason why we should think more carefully about this is because oftentimes analysts, they look more at the numbers, they look more at the results, but they don't look at the operations of the business and what the company is doing to improve, to grow, and to maybe gain more market share and have a strategy in place for the next 5, 10, 15, 20 years, where these guys could become maybe a billion-dollar revenue generator and then grow to $10 billion and much more. So if they are making this strategic acquisition that has secure messaging and file sharing services, that means that they're going to probably start getting more into the social component aspect, right? They already are with this format. But who else has social component aspect where you share messaging? Facebook has that. LinkedIn has that. Microsoft has that with Skype. And so does Google. So is Zoom with this application starting maybe to develop their own application where in the iPhone and other phone devices, they're going to come up with their own chat application that has video conferencing? And guess what? It's secure, it's encrypted, and you no longer have to worry about security and anyone hacking into those messages. So maybe it's gonna be here in your device, right? In your phone. That's interesting. I wonder if that's what the CEO and the CFO and the internal executive team is thinking about. It's quite interesting, right? This is something to think about. That's how I look at it. Maybe you might have another idea. But here's also what's important. About 2 weeks ago, Facebook came out and introduced their own video conference application. When that news hit the wire, you can actually see the stock of Facebook increase about 5 or 6%, and the stock of Zoom decreased 10% in the last hour of the trading day. Zoom market cap, okay, they lost several $billion in an hour because Facebook came out and made that announcement that, hey, look, we have our own video conferencing. Now we're gonna go and compete with Zoom. I mean, talk about savage. Talk about business and competition. You're introducing a competing product with Zoom. I mean, that's savage. But now Zoom, as a response, they made an acquisition. Okay, Facebook, you're gonna do that? Don't worry, okay. We're developing our own social application. We might probably even develop our own community where people are gonna be able to have their own profile. And guess what? We have a better video conference than you. So you're taking a punch at us? Well, we're gonna punch back and we're gonna punch harder. Folks, this is business, okay? Remove all of the terminology and the principle and the sexy terms and jargons that you hear about, competition, principles, marketing. It's pure competition. It's like two giants fighting, David versus Goliath in the ring. What product are you gonna introduce? What product are you gonna counteract? What features are you gonna put in there? What is gonna be your marketing strategy, your messaging, the design, the experience? That's business, folks. And that's what's happening right now in the tech world when you're seeing that. So this is gonna lead me now to my next point, which is looking at it from other analysts and what they're saying. So in this next slide, we have right here analysts from Morgan Stanley, RBC, and Credit Suisse. And they each one of them has their own unique perspective, which I think is important for us to understand, because they all actually have valid points. But who's right? Who's right? Time will tell. But what's important also is their price target. Look at the price target. Let me highlight this for you. Meta from Morgan Stanley has a $105 price target. The stock right now is at around $164 a share. Okay. Here you have Alex from RBC, $125 price target. Here you have Brad from Credit Suisse, $105 also price target. Now, why do they have these price target that is below the current stock price? Why is that? It's our job to understand that, and then maybe you can come up with your own reason as well. And that's what I'm trying to do, give you a different perspective, give you the story, what's been happening, so that you can apply your own critical perspective or be a critical thinker when it comes to assessing this company and really understand the operations of the business, okay? And does it support the current stock price? So here's Morgan Stanley. Here's what I found interesting from this analyst research report. Here, it's really increased competition. So competitive announcements point to growing attention on what Zoom could do with their install base. As we explored last week, remember I talked about Facebook, as we explored last week with Facebook Messenger Room announcement and highlighted again with Google Meet announcement and Microsoft earning last week, video is going to remain an intensely competitive market. Okay, so that means that there's going to be increased competition against Zoom. So are these guys going to take away from Zoom's user base, and are they going to be able to convert them into paid subscribers? Or if I'm a user of Zoom, and by the way, I do pay for the service because through our analyst program, I do teach and we do discuss a lot of these analysis in greater detail. And when I'm having one-on-one conversations with our students, we do it in this format. So I am a paid subscriber or user of Zoom. But what about the free members? Are they going to upgrade and pay? That is one of the challenging features out there. And maybe those users that are free users of Zoom, maybe they might adapt Facebook, what do they call it? Messenger room, maybe they might adapt that, or maybe they might go with Google or maybe Cisco, LogMe, which are other competitors out there as well. Again, time will tell. Here's another important point right here. So in the near term, key to valuation movement will be how of their free uses they can convert to pay, and how many people continue to use video as default communication post-coronavirus. So is this going to be the norm? Would this leave a legacy? Will they able to convert the free users to paid users? That remains to be seen, and that is one of the major drivers of their high valuation. This is one of the reasons why maybe Morgan Stanley says, look, valuation has gotten ahead of itself. I don't think it's worth the multiple that the market is paying for it right now. So I'm going to give $105 price target. That's their perspective. I think it's interesting. It's valid. Are they right? Only time will tell. We'll see. Now let's look at the other analysts. Here we have RBC. Now RBC has $125 price target, much higher than Credit Suisse and Morgan Stanley. And here's what they're saying. And again, what I found noticeable here is in this bullet point. So while some investors have had mixed reaction to both the remarkable usage spike and media scrutiny about security and privacy issues, we believe that the company has leaned in at a time of crisis to ease the impact and the burden. So because people can communicate in person, Zoom comes in to the rescue and gives us their video conference application, which allows us to communicate in this format. Okay, I see it. We believe the inherent and lasting network effect of these actions will lead sustained positive value creation for future to come and position Zoom as the de facto global communication platform. Wow. I mean, and I highlighted this. I mean, this is a very bold and interesting statement. We believe the inherent and lasting network effect of these actions will lead a sustained positive value creation for years to come and position Zoom as the de facto global communication platform. And I think from what you're seeing, what they've been doing, I think they're delivering on that point. I think they are. So this is what the bull case is, that this will leave a legacy and this will become like the normal, right? But the challenge remains, can they convert free users into pay users and cross-sell all the other products that they have within their infrastructure or within their organization? And I finish here. The most notable near-term impact has been dramatically increased user engagement and a rapid education in how to convert an enterprise product for customers' use in terms of out-of-the-box scrutiny and privacy settings, as well as managing and scaling global infrastructure. Have yet to quantify. And by quantifying is, okay, can they sustain this? So this is from RBC. I think that's another great valid point. And finally, we have Credit Suisse, who has $105 price target. Now, Credit Suisse, I think they are hitting on all of the important points that us as investors need to concern ourselves with. Number one, valuation. Credit Suisse thinks, look, you guys are just too rich. Look here, on valuation, our downgrade centers on Zoom's ultra premium valuation, the richest in the software video space of 40 times EV over calendar year revenue. This is enterprise value over calendar year revenue, even against our upside case of 1.5 and 2 billion calendar year, okay, revenue assumes a 6-time new customer revenue versus our public. Okay, Zoom trades at a 24 times to 19 calendar year 20 and 2021 revenue relative to high growth peers of 19 and 15 times. So you can see here that Zoom, it is trading at a premium, okay? But that's because of the brand. And I think more importantly is because what they've been able to do with education. They've been able to penetrate the education market where all major institutions that provide education content to all university students, 20 million, but when you look at the primary education market, preschool, elementary, high school, and then the university level, it's 70 million students in the US. And it's elevating their brand. I don't think the other software video conference applications have been able to do that. So this is maybe one of the reasons why the market is paying that high premium, okay? And we don't know what Zoom is planning behind closed doors on new features, new products, new social network or activities that might come out that people might actually be willing to pay. We were probably seeing the beginning of a company that can really bring value not only to employers but to every citizen, every person or every human being alive, right? If you use just your creative imagination. Now, some people may say, no, Luis, you're wrong. I don't think they're going to be able to execute. They're going to fall flat on their face and the stock is going to collapse. I'm okay with that. That's fine. If it happens, it's management team's fault. They didn't execute the way they should have executed, right? But this is what Credit Six is pointing out. High valuation, increased competition, security scrutiny, and then risk. Our revised $105 price target is driven by our updated DCF analysis and ascribes a slightly higher probability of an upside scenario, risk to underperform. Okay, we understand all the other points right there. But we're seeing how they're valuing this business, and again, very rich premium valuation in the face of increased competition, also in the face of increased scrutiny, and also Zoom was slapped with a lawsuit. I believe it was from New York Attorneys General. I think they filed a lawsuit against Zoom because of the privacy issues that they had. All of the gaps in their application that they didn't patch up that show the maybe inefficiencies in their application was brought into light with a higher increase in usage and users. But they're working in fixing that right now. So all of these things are negative cloud surrounding the valuation of the company right now, okay? So if we take what these research analysts are doing, and then we look at valuation, right? So this takes us now to the second point of our three-step process of understanding and analyzing a stock. The second part is applying our technical skills. What valuation methodology could be applicable and appropriate to Zoom? If you look at Morgan Stanley, what are they using? They're looking at multiples. They're looking at enterprise value over revenue, okay? They also use FCF, which stands for free cash flow. Sometimes in the tech space, when companies are burning through cash and losing money, you will not be able to do valuation on a PE basis, unless you look at forward multiples. In tech space, you could also look at another metric, and that is your enterprise value divided by free cash flow. Remember in earlier slides, I said that Zoom had positive free cash flow, which is a good indication. So you could take their enterprise value divided by free cash flow, and that could be a multiple that you can apply to the valuation. This is what Morgan Stanley is using. You see here, free cash flow, free cash flow, and they also have enterprise value over fiscal year revenue. Now look at RBC. What multiple or what metric are they looking at to value the business? Enterprise value over revenue. This is on their base case. You could see also in their upside scenario, free enterprise value over revenue, and also enterprise value over revenue. So they're looking 2 years out, okay? They're not taking LTM. They're looking at 2 years out in terms of revenues that have probably fully materialized and are fully capitalizing on this emerging trend of staying at home economy and applying video conference as the new norm of business productivity and how employees just conduct their meetings. Look at Credit Suisse, same thing. They're taking calendar year 2020 enterprise value over sales multiple 50 times, which is high. This is on our blue sky scenario. I love how they change the scenario right? The way they name it, instead of traditionally an upside, a base case, or a worst case scenario, they call it our blue sky scenario. So blue sky is probably the best case scenario because it's clear, it's going up. We're looking upwards. I like the creativity there. Kudos to them. So they gives in a price target of 160. Then if you look there, gray sky scenario, maybe gloom and doom, worst case scenario. Woof, look at the, oh my God. $60. Ooh, that's ugly. Look at the multiple. Woof. On a calendar year enterprise value over 2020 sales, 18 times. Look at their blue sky multiple, 50 times. Ooh. So now we can take this methodology and apply it to our own analysis to come up with an implied share price based on what we believe an appropriate multiple is warranted on Zoom, giving the story, the emerging trend, and also the growth of the business. And we're going to do that in the upcoming slide. So before we dive into that, of course, let's look at expectations. What is the rest of the street anticipating revenue, margins on the EBITDA and EBIT side to be, and also earnings per share? So you can see here that for 2021, the street is anticipating a 50% revenue increase. Remember, the guidance that management gave was between 44 and 46%, if I'm not mistaken. And actually, if we go back to that slide, let's take a couple of seconds here to look at that. Look here at the last bullet point, guidance, revenue, what they're anticipating, 45 to 47%. The rest of the street is actually expecting, on a consensus basis, 50%. Remember I said understate and over-deliver? This is the game that a lot of these high-tech growth companies like to play. So this is one of the reasons why you're probably seeing better expected revenue growth for 2021. Earnings per share, the bottom, fully reported on a GAAP basis, 5 cents. Okay, so this decline on an earnings basis, EPS basis, right here. This decline, this is GAAP, by the way. This is what you'll see in a 10K or in a 10Q. It's not normalized. When it's normalized, you're extrapolating one-time charges, you're extrapolating stock-based compensation, which they do have a lot of. It would be 5 cents, and that's probably because of the increasing shares that they are issuing. But on a normalized basis, you see that it is expected to be 43 cents. And normalized means that you are removing your stock-based compensation. I'm getting a little bit more technical. This is more on the investment banking side when you're spreading comps and you're doing your DCF analysis for clients. But I'm just trying to give you a little bit more clarity in the technicality behind EPS on a normalized basis and EPS on a GAAP basis. So there's a difference. But we're going to focus more on revenue because we saw the other analysts were applying enterprise value over sales multiples to come up with their price target. So the next slide shows industry comps. And we can see that on a sales multiple standpoint, their current LTM sales multiple, look at it here, 77 times. Whereas the industry, mean and medium, is between 10.5 and 5 times. I mean, these guys are definitely trading at a significant premium. But look at the sales growth. Okay, then look at the sales growth column. They're growing above the industry, right? Every other competitor, they might have a competing product. Okay, they're growing almost twice as fast as everyone else. But the question is, okay, do they deserve such a high premium on a sales multiple basis? That's your job to answer that. I have my own reasons. I have my own take on it. I'm not going to reveal that yet because remember, I want to cast a vote. I want to see what your opinion is. Should we buy the stock? Should we sell the stock? I'm not going to give you my opinion just yet. So if you also look at another metric, right? Enterprise value over sales multiple to growth ratio. So you're comparing the sales multiple divided by your growth times 100 says what the market is paying for that sales growth. So on average, 0.5. And Zoom, the market's paying that premium, 2.2 times. So you might draw the conclusion that Zoom is overvalued. Okay, but then other people can justify and argue that says, look, maybe they deserve that premium because they're growing faster than everyone else. They've managed to execute from an execution standpoint, they've been able to lock in all education institutions in the country. And because of that, millions of people now recognize the Zoom name, the brand, what they do, and now upwards of 200 million people are using Zoom on a daily basis. So from an execution standpoint, I mean, it's like, if you're playing baseball, you hit a home run, you knock it out of the park. That's what they've done. But of course, the coronavirus was the catalyst, was the change in trend that laid the foundation for them to get to this point. And again, the question is this sustainable? Is it sustainable? That's the question that is up and open for debate. And the upcoming quarter, which I have the actual date in the upcoming slides, when it's going to be, that's what you should be paying close attention to. So let's move on now to the next slide and walk you through the process of using sales multiples to come up with an implied share price or your own price target. Now, this is a little bit technical, and I'm trying to simplify this, okay? So how do we take something that can be intimidated and just make it very simple? So here we go. From an analyst standpoint, so we have Morgan Stanley, RBC, Credit Suisse, we see their price target. We see all 21 analysts that cover Zoom. This is the mean and median price target that they have on the company, right? Let's just say 125. That's what the street is expecting. If we look at the company sales right here, this line, we see their sales over the next 4 years and what it's growing. Fine. We also have year-over-year revenue growth. Okay. If we take the industry sales multiple, which we have on our first analysis, this right here, number 1, industry median EV over sales multiple. What is that number? 10.5. Remember the previous slide, we saw the mean, it was 10.5. We're just going to take 10.5. You take that 10.5 and you multiply it by your sales. That is going to give you an implied enterprise value of the business. What is enterprise value? Enterprise value is the entire structure of ownership of the business. It incorporates the equity holder and the debt holder. You combine those together and you get the enterprise value, or as other firms like to call it, firm value. That is the value of the entire organization. Every company has two sets of ownership. Equity holders, which are your stockholders, minority interest holders, and then you also have your debt holders, the people that lend money to the company. Those two are the ownership claim to the business and the cash flows, okay? So that is enterprise value. So you take the multiple, you multiply it by your sales, and you get an implied enterprise value. Then you extrapolate your net debt, the cash and the debt component of the business. And then if you want to get even more technical, if they have minority interest, preferred stock, you could account for all those things. But once you remove the net debt component, which is right here, okay, where do you get this net debt? From the company's most recent filing. It could be the 10K or the 10Q. Once you extrapolate the net debt, you end up with your equity value. This is the portion that I myself as a stockholder am concerned with because I'm an equity holder. So this equity value, in this case right here, 10.6 billion, you take the equity value divided by the company's shares outstanding, okay, 279 million, and that gives you an implied price target. See here, $38. Now you might say, how do you get $38? Well, it's because of the lower multiple. We're applying the industry multiple to Zoom, and that industry multiple is 10.5. What is Zoom? Current enterprise value to sales multiple. This takes me to number 2. LTM EV over sales multiple. This is Zoom multiple right now. 7.7 times. Take that 7.7 times and apply it to your sales. Multiply it, right? That's going to give you your enterprise value. Look at that, 71.9 billion. Then extrapolate the debt component, your net debt component, and then it gives you an implied equity value. Divide the equity value by shares outstanding, and then you end up with an implied stock price, $260.85. That represents an 89% upside. And you could take that same multiple and say, okay, that multiple, we can pay for that next year. So if you think that multiple can be applied for 2022, take the sales, multiply by that multiple, That's going to give you an enterprise value. Subtract your net debt. That's going to give you an equity value. Divide the equity value by your shares outstanding, and that's going to give you an implied share price or your price target. And you can, keep doing that. But the question becomes, will that current multiple be applicable for the next 2 or 3 years? In actual practicality, the answer is no. Why? Because the business fundamentals, the conditions of the economy goes up and goes down. It's a cycle. Okay, so this brings to light what we were talking about earlier. Is this sustainable? The growth trajectory that Zoom is representing, is it sustainable? And if it's not sustainable, then the multiple will come down. It will be compressed. So that leads me to the third analysis, which is this right here, where we're saying, okay, look, we're going to pay a reasonable multiple that's in line with the company growth. So I looked at the enterprise value multiple to sales from the industry competitors, and you saw that people were paying, the market is paying 0.5. So I said, okay, what if we pay 0.8? Let's give it a little bit of a premium. Right now, Zoom, the market is paying 2.2 for that sales growth from a multiple standpoint, EV over sales multiple. So if we bring that multiple to 0.8, in other words, you take the growth from sales, you multiply that by 0.8 and then times 100, you're going to get with an implied multiple of 40 times. Now you have the multiple, and you can apply that multiple, multiply by sales, and you get your implied enterprise value. Subtract your net debt, you get your equity value, divide equity value by your shares outstanding, and you get an implied price target. Now you can see that number 3, the methodology here, it's more in line perhaps with what other Wall Street analysts are saying. Look at this multiple, 26.7, okay? That 26.7 EV over sales gives you an implied stock price of $22, which is below the $174. Wow, so before I was saying 164, oh, I was wrong. It's $174. Ah, man, the stock actually went up in the last 2 days, Thursday and Friday. Okay, so they are 174. And if you apply a forward multiple of 26.7 EV over sales, and you solve back for your stock price, you get 122. So this is more in line with what these analysts are saying. Now, is this right? Do they deserve that multiple? That's up for debate. That's for you to come up with your own analysis and then buy the stock or sell the stock. Put your money where your mouth is. The market will tell. Only time will tell. It doesn't mean that because we've done this analysis, we're going to be right. Okay? A lot of these analysts, I mean, look at this. A lot of these analysts have a very, very low price target, and the stock is at 174. And if you see the trajectory of the stock, it's been increasing. Meanwhile, these analysts are saying sell, sell, sell. It means that the buy side, all big institutional investor, if they want to own the stock, valuation doesn't matter. Valuation is thrown out the window. That's something else that, we can do an entire lecture on, how growth companies with high valuation multiples, traditional methodologies like a DCF, a comparative company analysis, sometimes is not the best way to value the business. Why? Because there's just demand for the stock. And when there's limited supply and multi-billion-dollar mutual funds and hedge funds want exposure to this company because it's underrepresented in their portfolio, when you take that one fund and multiply it by thousands of funds that want to own it, that they just want to have it in their portfolio so that when they share it with their clients, hey, look, we own Zoom. We had exposure to this stock. So sometimes, eventually valuation does catches up with the stock. No one has a crystal ball. No one knows when. The time it catches up with valuation is when they miss a quarter, when they underperform. And it just shows to all the investor community that, hey, look, valuation is too rich, and they miss a quarter. They were priced for perfection. And when they miss a quarter, then the stock will definitely get slammed. Usually they get sliced by half, and they get severely punished. So you need to understand that when you're applying this level of methodology and valuation, okay? I also illustrated here for those of you that are new to this level of analysis, how do you calculate enterprise value? I included right here in a more detailed way. So you get the stock price. You take your fully diluted shares, and fully diluted shares could mean you could take the shares outstanding that the company have. Where do you find it? Go to the SEC filings, right? SEC.gov. Look at the company's latest quarterly or annual report, either the 10K or the 10Q, and on the very first page, at the bottom of that very first page, they're gonna say shares outstanding. Zoom has two classes of shares, Class A and Class B. You have to combine those two to get 279. Once you have that shares outstanding, then you multiply by the price and you get your equity value. Then you adjust for cash and equivalents, marketable securities, okay? Notice here that it's a negative. I'm subtracting their cash and marketable security. Why? Because we make the assumption that the market is giving you a premium for that equity value. So we have to extrapolate it. Also, we can use that cash to pay down the debt. In terms of debt, they only have operating leases, 72 million. You take those and you get net debt. Then you subtract your portion of net debt. In this case, they basically have cash from the equity value and you get your implied enterprise value. Again, this is a little bit more technical. For those of you pursuing careers in finance, especially investment banking or equity research, you better know this. You should definitely know this. For those of you that are not too much into the technical side, it's okay. Just understand that enterprise value represents the equity and the debt side of the business, which shows the entire value of the organization, okay, giving the stock price. So I hope this analysis is simplified on how you can use sales multiples to come up with an implied price target on Zoom. And again, I'm not giving my price target, I'm just saying what the analysis would show. And this third analysis over here, 1, 2, and 3, I think when you look at these sales multiples based on the growth rate of sales, is probably a more applicable methodology to apply. And what the rest of the street is focusing on, I believe, is this one right here. They're looking at 2022 numbers, or you could even apply it to 2021, but this is probably a more reasonable multiple that other analysts are giving to this company. You might disagree, and it's okay, but you need to be able to justify that, all right? So this takes me now to open up our polls. I actually want to open up the polls and see what you think. Should you buy Zoom or should you sell it? Is it a buy or is it a sell? So let me open up right now our polls and see what our audience is indicating. So let's see right here. Let's pull up our poll. Let's see where we have it. Polls. Let's open it up. Launch, and it is launching. So you should be able to see it on your screen. Cast your vote right now. Let's see where we at. I'm quite excited just to see what you guys think. And while you're casting the votes, here's what one of our analysts in our program put together. Okay, he put together his own slide, the entire process. He had his own investment thesis. He had his own recommendation, and his recommendation was a sell. He had a $97 price target, and the reason that he stated of why he had a 97 price target and a sell rating is because for here, overvalued stock price, but potential for longer term growth. Number 2, strong brand equity customers, frictionless service and video communication, okay. Catalyst, security and privacy issues, okay. So we see that. So it's all surrounding the valuation, right? And also privacy, increased competition, and all that sort of negative headwind that the company is being faced with, all right? Now, when you put it all together, this is what you should take away from the performance of the stock year to date and what they reported in Q4 fiscal year 2020 numbers, which is number 1, superior platform with strong top line revenue growth. Number 2, they increased in 2020, well, the whole 2019 year, their fiscal calendar year ended January 31st, 2020. But for that year, they increased their customer base by 31,100 new customers. That was a 61% increase. I mean, that's insane. Number 3, security and privacy issues still remain. That's a concern. But you saw in the slide where we talked about their response to the coronavirus, they're patching those things up. They're spending a lot of time and effort in fixing any type of security or privacy issue that their technology may have, right? So all of those gaps that have been unfilled, they're patching it up. They're filling it. So I see what they're doing. Number 4, increased competition from Facebook, Google, LogMe, and Microsoft, and others. So we also understand that. Number 5, ability to convert free users to paying users post-coronavirus will still remain a challenge. Will this leave a lasting legacy, and will this be the new norm? Or is it just a temporary momentum stock that the market is just propping up? The main catalyst to all of this is going to be the upcoming quarter. June 2nd, at 5 p.m., they're going to report their first quarter earnings. And this is, I think, what's going to give us more clarity on what's to come. So the other thing here is to look at the technicals, right? Let's look at the chart. I mean, here's where they're at right now, 174. Okay. From a technical analysis standpoint, the way I will look at this is by, let's go to the weekly. I think the weekly is a lot more clear. I mean, it's unbelievable. Look at this, from $75 in January, early January, or actually no, they opened up January around $67 to $174. Look, folks, the right time to have bought this stock, if you really want me to show it, the right time to have bought this stock is right here. Boom, right there. What's the clue and indication? The increase in volume. Look at this blue bar right here, volume. Increase higher than any other period since they did an IPO. Right there, volume. That is institutional sponsorship. That is big hedge funds, big fundamental-based investors that have an army of analysts doing all the research, looking at the fundamentals, putting their money where their mouth is, buying the stock in anticipation of the entire economy, businesses adapting their application, their video conferencing service. And they were anticipating all of this. You could have bought it here, or you could have bought it here at resistance when they broke out. That's it. Those are the only 2 times you could have bought the stock. Or on any pullback. So if you want to draw a trend line from a technical analysis standpoint, right here. You could have bought it right here as well. This is a weekly timeline here. This is a lot more clear. You could have bought it right here, February. You could have bought it maybe in April. You could have even maybe bought it in March. But now I'm being very technical in analyzing stocks. So where do I think this stock can go, provided that we break this all-time high area right here, right? This all-time high around what is it to be exact? 180, 150. If we break it, where can it go? Short term, remember, Gartley pattern, that first wave would match the second wave. If we break it, it can go to 201 because the momentum is in favor of the stock moving higher. The fundamentals right now, all of the caution from valuation methodologies hasn't caught up yet. So the momentum is to the upside right now. So you may not want to fight, you don't want to fight the trend. Okay, maybe you want to wait for earnings to see if they beat or miss expectation. But this is where I think the stock can go, provided that they break all-time highs and the momentum continues to the upside. So that's just from a technical standpoint. From a fundamental basis, if we look at the multiples and even do a DCF analysis, maybe the stock is overvalued and maybe 125 is a more reasonable share price. So let's showcase our poll. Let's end the polling. And what do we have? So we have 77% of you said sell, and only 23% of you said buy. Okay, that's interesting. So everyone is on one side of the boat here. Okay, with 77% of you are saying sell. If you say sell, just don't buy it. Wait for a pullback. What do I mean by that? Here, let's look at this on a weekly basis. Wait for a pullback. Wait for the stock to maybe come back down to, let's pull up my marker. Okay, wait for the stock to maybe come back down to this trend, the lower channel of this trend right here. Wait for it to maybe come back here to $150 for another move to the upside, provided that the fundamentals still remain strong. If the fundamentals are not in line with the stock, be careful, maybe find another stock. If you're not a trader and if you don't understand technical analysis, if you don't have really good risk reward or a risk management system and are very disciplined, then you shouldn't be day trading or trading this stock on a short-term basis, right? Focus more on the fundamentals and buy right and sit tight. I'm going to slowly introduce more lectures on technical analysis and how do you apply portfolio management, weighting of each stock, how should you sell, what is a good risk reward measure, and just really take everything that I'm sharing and apply now the execution standpoint, the portfolio manager perspective. All right, folks, so there's a few questions that have been asked throughout the lecture. So let me see if I can get to a few of them rather quickly. All right, so let's see here. Anna, question. The big fluctuation of Zoom's value is contrary to my intuition. Okay, so the big fluctuation of the Zoom value is contrary to my intuition. Okay, if you could type in a little bit more of what you mean by your contrary to your intuition, give me a little bit more clarity on that and maybe I can comment on it. But okay, you have your own opinion, that's okay. Let's see here. Hey Luis, my name is William. Hey William, and I'm very curious about how the Wall Street expectations are determined for public companies, stock price, EPS, and guidance. That's a good question, William. Here, let me give you a little bit more insight. And I've also had other students, ask me, how do we come up with this growth and expectations? Look, this revenue growth that you're seeing right here, year over year, okay? How do analysts come up with this? There's different ways of coming up with projecting a company revenue. So you could do a revenue buildup. You can be very detailed here. And the most simplistic way is to say, if a company has 2 or 3 products, right? What is the price of those 2 or 3 products? How many people are they selling it to? So what is the addressable market? What about the competition? If the addressable market is, let's say, 1 million people, so you could sell your 3 products to 1 million people, how many of those products have you actually sold? If you sold maybe 1,000, then you don't have 1% of the market yet. If you sell 10,000, then you have 1% of your addressable market. So if your addressable market is 1 million individuals and 1% of 1 million is what, 10,000, then you have 1% market share. Now the question becomes, how do you increase from 1% to 10% to 20%? It has to do with marketing. It has to do with increasing your team, your sales team, and spending more money to elevate your brand. Then you have to look at Zoom's operating expenses. How much are they spending in R&D? How much are they spending in marketing, in advertising? And do they have enough staff to justify an increase in revenue? So when you really look at all of their revenue, their sources of revenue and product, you could create a revenue buildup. Here's an example of that, of what I mean. And this is what one of our analysts put together. So I'm actually going to show you what his presentation looks like, right? This was his presentation. And he basically put together, let's see, so this was in Europe. He took the different price points coming from Europe. So you can see here different products, how many users uses those products. Let's see did he showcase that revenue buildup? Americas, Asia Pacific, EMA, percentage, customer. Okay, revenue, total revenue. All right, so that's percentages. Addressable market. Okay, so he didn't break down the number of users. Customer base has grown. Actually he did. I think this is on the EMA basis. Number of customers growing. So you could take the number of customers that they have and then multiply by an average revenue per customer, and that can give you a little bit more indication of how you could do it. That's just one methodology of solving your driver. And then when you look at the consolidated total revenue, when you look at the year-over-year growth, it should be a little bit more in line with the industry, or if you think that they're going to beat those performances. So it's really about understanding the business and solving the revenue equation. Product, price, and volume. Price times volume. that would give you an indication of revenue. So that's just one way of thinking about it. I hope it answers your question there and gives you a little bit more clarity. Let's see, Patel. In your opinion, what is their competitive advantage? Video conferencing has been around for years with multiple players. What stops tech giants like Microsoft, Google to make these video conferencing? Hey, that's a great point, Patel. Great point. So then why didn't Microsoft use Skype to get to the level of Zoom? Why didn't Google use their video conference or Cisco? GoToWebinar. I mean, I use GoToWebinar for years. Why didn't they? Simple. Their user interface, their application is actually better. It's a better experience. And I've used all of them. I like Zoom better because it is designed a lot better. And it's easier, and they have more features, and now they're making it even better. They're improving the experience from the educator standpoint or the business owner standpoint to conduct these video conferences. And I'm telling you, I've used all of them out there. Some of them are more complex and easier to use than others. I personally like Zoom. And I'm sure if you adopt Zoom and you use it and also look at the other experiences, you're probably going to say that Zoom also has a better product. That's just my own opinion. But what's very key here is that they were able to focus on the educational in the market right here, global education. This is big, right here, this right here. Why? In the US, 70 million students. When you look at from 0 to K-12 and then higher education at the university level, total 70 million students are now using Zoom because all universities, the professors, they're using Zoom. So it's kind of like a chain reaction or a domino effect, that if one institution that delivers educational content to 20,000 students, so one professor or multiple professors using Zoom platform to reach thousands of students, it just elevates the brand awareness of the company. And I think that's why they've been more successful than these other players that have been around. The execution, that's just, it's smart, it's genius. Here's another example. From me, as an operator standpoint, Romero Mentoring, we've created our own analyst program. I have the best analyst program out there, without a doubt. I mean, you can speak to the students in my program, and it's because of the experience, how in depth, the process that we've created. It is the best analyst program out there. It's just the user experience. That's it, buddy. I hope that answers your question, gives you a little bit more clarity. Let's see, another question here comes from Sharon. Have the target price been revised after the launch of the Facebook room? And Shannon, you could see here with, who was the one that mentioned it? Was it these guys? Credit Suisse. Yeah, they mentioned it in their zoomed out at linear term. We did cover it right here. Who was the analyst that mentioned it? Zoom, blah, blah, blah. Was it Morgan Stanley? Yeah, see, Morgan Stanley mentioned it. So they updated their price target, 105. So Morgan Stanley talked about Facebook Messenger Room coming up. So these analysts are aware of it, and they're including it there when they talk about increased competition. Okay? Here's another one, Anonymous. Okay, Anonymous. Can you explain the third methodology, like how to use the growth multiple? Okay, very simple. And again, folks, experiment this at home yourself, right? Use your own creativity and the lecture to do this on your own. Quite simple. Here, look at the industry. Look at the competitors. Take your sales multiple, okay, divided by the revenue growth 1 year to the next, divide the denominator, multiply the denominator by 100. So here will be the equation for that. It would be your sales, right, multiple. Just going to abbreviate this. Okay, divided by your sales growth, okay, times 100. In parentheses, the denominator. This would give you this ratio right here, right? And when you take the mean and median, it's 0.5. Now, I am saying that because Zoom deserves a premium because they figured it out on how to get their brand to almost everyone in the world already knows who they are because they were successful at it. I think they deserve a premium. And I'm assuming a 0.8 premium. Okay, so now you have 0.8. Now it's just solving the equation, right? So if you have 0.8, right? So if you take 0.8, now what do you have to solve for? You have to solve for X. You have to solve for what would this multiple be for Zoom, okay? Provided that you're applying this to the growth, okay? So you're gonna take this, multiply by the growth, times 100, and you're gonna get the implied multiple. It's just basic arithmetic. Do this math on a piece of paper until you understand it, and you're gonna see it makes sense. So then you follow this process in this slide. That's what I'm doing exactly right here. Okay, so I'm taking my 0.8 and I'm multiplying that 0.8, okay, by this growth. 33% revenue growth for 2022. You take those two, you multiply, and then you convert it into a whole number by multiplying by 100, you get 26.7. Then you take that 26.7, you multiply by your revenue number, and it gives you an implied enterprise value. Then you subtract your net debt, then you get your equity value, you divide it by your shares outstanding, and then you get an implied price target, okay? So I hope that makes sense. Again, it is technical, but once you do it on your own with a pen and paper and you keep doing it over and over, and do your own Google research as well to familiarize yourself with this methodology and replay this video, this is gonna become easy. It's very easy. It's just basic arithmetic, but understanding the process and the methodologies and the terminology. Once you understand that, this is easy, okay? Let's see, who else we have here? Sharon, if people are selling Zoom due to privacy issue, does that mean Microsoft will rise because Microsoft Teams became the main alternative to Zoom? So Microsoft will be an alternative because people don't like the privacy settings on Zoom? I mean, that's like me being a mind reader on the millions of people that use Zoom and are maybe thinking, let's go to Microsoft because of Zoom privacy issues. That's a tough question. That's a tough question. I mean, I wish I knew the answer to that one. But let's entertain that question, right? Let's entertain it. Let's see. From a user, myself, let's say as an employer or an educator, would I change to Microsoft? Well, Microsoft has Skype. I don't use Skype to conduct my lectures. I don't use Skype to talk to my team because Zoom has a better interface. And I'm used to working with Zoom. There's a steep learning curve, right? You have to familiarize yourself with the platform. You have to learn the little features. So it takes time. But once you adopt it, I'm already conditioned to using Zoom. Do you think I'm going to leave Zoom and go and learn how to use Microsoft when I'm very busy? Sorry, no. So to switch, there is a steep learning curve and a time that is going to be painful for me to adapt that new application. And I don't think I would change. I don't change. That's how I view it. Now, other people might look at it differently and they might adapt it. But again, I've used all these software video communication application. Zoom is the best one. Zoom is the best one. At first, I was using GoToWebinar, GoToMeeting. That's the one I was using. And I didn't want to change. But because Zoom had additional features and services, I made the switch. The first week, it was annoying. I didn't want to get familiar using it. How do you record? How do you draw? All this other stuff. Because I've already conditioned to use GoToWebinar. But after a week and 2 weeks, I saw how easy and how the value of all the features that Zoom has. I won't change now. I wouldn't change. So that's my example, right? And I think you can apply that to your question and all the millions of users. And I'm sure that employers will probably be on my side for that one. It's not going to be 100%, right? Maybe 90% will be on my side. The other 10%, who knows? Maybe it's because they don't like Zoom or whatever the case may be. But I'm just using my own example and maybe making the assumption that 90% of other users from the employer side and educational standpoint might agree with me, right? I hope that answers your question, right? It's an interesting question, but yeah, I wish I had access to all the millions of users and just do a poll, do a little survey to get that data. That would definitely give us an insight and an informational advantage to make a better investment decision on Zoom. I think that would be great. It would be a great case study. Let's see. Have you, Cheyenne, if you have Zoom select right now, would it be wise to hold it? Okay, so Cheyenne, if you have Zoom right now, would it be wise to hold it or sell it closer to earnings? Okay, so now you're getting more into the execution, the trading side of things, and I have my own rules on that. That is something I'm going to do other lectures on, to really show you a little bit more of my trading strategy, my philosophy, and how do I integrate all of this stuff and show it from a practical standpoint. Look, when you're going to play earnings, sometimes stocks will gap up. Sometimes they miss, they gap down, and they get destroyed to the downside. So, per my rule, I usually don't like to hold into earnings. And if I do hold into earnings, it's not 100% of my position. I'll probably go into earnings with 30% of my position, not all of it. And when you talk about portfolio weight, what percentage of my portfolio is it concentrated in one idea? The most I'll be willing to put would be 20%. So if you have 20% of your portfolio concentrated in this idea and you're up and you're going into earnings, the wise thing would be to maybe take some profits and reduce that position to maybe a 5% stake in your portfolio. That's the wise thing to do because you're protecting your profits, you're minimizing your downside in the event that they miss earnings. Why do I say that? Well, because you might be in situations where, here, I think this was a great example back then. Stamp.com. Yeah, this looks good here, but here, this is what I mean. Look at here. Oh, you don't want to be caught in situations like this where a stock is at $200 and right after earnings, boom, the next day it's down it's down to $84, right? This is cut by half, down 50% overnight. This is why I don't hold 100% of my position into earnings, okay? And it just takes time, it takes more practice, it takes more experience in the market for you to see these scenarios playing out over and over and over, and then you develop your own philosophy, you develop a strategy that is in sync with your personality. That's what takes years to learn. So I hope that answers your question. All right, folks, so I only have time for one more question, then we'll wrap it up. Let's see. When comparing multiples, is it more promising for a company to have higher or lower EV over EBITDA or EV over sales multiple compared to the industry? It depends. It really depends. Is it more promising for a company to have higher multiple? I mean, look, let's go back to the slide. Comps. It depends, right? I could make the argument that Zoom is overvalued and it's going to go down, right? Just the same way I can make the argument that Zoom is trading at a premium because it's growing, they have the best product in the industry, and they deserve a premium and it deserves the higher stock prices. You can come up with creative ways to rationalize both arguments, okay? But at the end of the day, it's you coming up with your own recommendation and your own beliefs, but also knowing that you could be wrong and you need to have your own risk parameters, your own risk measurement and risk process to prevent you from losing 50% of your money, right? Like the example I showed you on Stamp, that will still keep you in the game and you won't get hurt even if you're wrong. This is a probability game, folks. At the end of the day, all of this analysis that we're doing, it's good to understand the fundamentals of the business and potential upside if the earnings do support it. But all this analysis and all this work that we've done here, we could still be wrong, right? But what's interesting and one of the characteristics of the best investors and traders is that they can change their minds like that. They could be long, and when they know they're wrong, they can go the other way and short the stock. You have to be very nimble and flexible. And you have to detach yourself from your ego. That's probably something that a lot of you guys probably don't hear about in the investment community or even in a classroom setting. Detaching yourself from your ego will make you a much more disciplined investor in the longer run. There's a lot of information in that statement right there. And maybe later, as we continue to do more content like this, I'll show you what I actually mean by that. All right, folks, so this is what I wanted to touch on and cover today. I'll end the session here. We'll wrap things up. Again, I hope you found value in this stock analysis. We went very deep into it. Now, the next thing to look at is the upcoming earnings on June 2nd. And if earnings are better than expected, then this stock has more momentum to the upside. If not, then the stock will probably continue to, it'll probably change direction, and you'll probably see it come to a more reasonable price target, like 120, 110, or maybe $100 a share. So time will tell, okay? So again, I hope you found value in this. I hope this helps you understand the process a little bit more of analyzing stocks, especially after they report earnings. So with that being said, take care, and I'll see you in the next one. Goodbye.